Hello and welcome back to Letters of Intent. My name is Pankaj Raval. I'm the founder of Carbon Law Group, and I'm with my co-host today, Sahil Chaudry. Sahil, how are you?
I'm doing great. I'm Sahil Chaudry, corporate attorney here at Carbon Law Group, and today we are talking deals.
We're talking deals, and these are actually smaller deals we're talking about today. We're talking about those deals that we help a lot of clients with. These are the $1 to $10 million acquisitions. So if you're looking to buy a business, instead of maybe starting one from scratch, but maybe buying an ongoing business or what they call a going concern, this is an episode for you. You're going to learn a lot about the do's and don'ts and things to look out for, and we're really excited to get into it. So today we're going to cover three major topics. The first one is what you're really buying when you acquire a business, the liabilities you didn't know you bought, and then assets versus exposure, the hidden side of acquisitions. Those are the three main topics we're going to cover today. And I'm going to be talking to Sahil, who deals a lot with these kind of acquisitions, especially in this space, the kind of SMB, small, medium-sized business space, to see what are we looking out for? What do we need to think about when you're buying a deal or when you're buying a business? So Sahil, I'm going to turn it over to you. So, first question is, what are the first things a potential acquirer should look out for when they're buying a business? What's that first step they should be thinking about if they said, hey, I want to buy a business?
So when we do intake and we're talking with someone who wants to buy a business, the first question I ask them is this an asset purchase or is this a stock purchase? And those are two very different things. In one case, you are taking the assets out of a company and you are putting them in a different container. That's a separate company. That's not the original company. And the other option is you do a stock purchase where you're purchasing the stock in that company, and that means you're inheriting the assets, but that also means you're inheriting the liabilities.
Absolutely. So interesting. So there's two types of acquisitions essentially we're looking at. There's asset and stock. And is one better than the other? Or do you always want to go with the asset because it sounds like, oh yeah, you don't get the liabilities? Or are there reasons to go with a stock sale?
It really depends because, and that's something I think clients hate to hear from a lawyer, is it really depends. But
it's true.
It's true. In this case,
this is not TikTok. We're talking about real deals. This is not something that can be summed up in 60 seconds. So you're right. It does depend.
Yeah, but let's walk through what would make you decide to go with one or the other. So if it's an asset sale, that means that there are certain key assets that you can use and you don't need the corporate entity in order to continue using them. So that is true most of the time, actually. Let's say somebody has invented a product, like some new kind of phone, and that phone has a patent. You can buy the phone, you can buy the patent, or you can have the patent transferred, you can have the IP transferred, and you could sell that. Now, on the other hand, let's say you are buying into a factory and that factory has vendor contracts and it takes months to get registered in a buyer's system. So let's say, for example, the garment industry, when you're registered as a vendor with Ross or Burlington or Nordstrom or TJ Maxx, that can take months or years to earn that trust to be registered as a vendor. And there's a whole vendor history associated with that. So for you to then yourself get back in touch with that buyer and try to sell the same product, it's going to be very difficult because there's a whole process of earning the trust of a company to be registered in their system. So that's an example where you might not want to go the asset purchase route. You want to go the company route. But there are a few things you really need to look at. If you're going to go the company route, you are going to need to look at a few different things that are key in a diligence purchase. And let me comment at least on one more reason you would want to go with a company purchase, a stock purchase, rather than an asset sale: goodwill. Sometimes a company has goodwill on the market and you want their name, you want that company. Sometimes they have key employees that are part of that company and you want to inherit those. So the more you need to inherit of a company that you're buying, the bigger reason you have to go with a stock purchase. If you can isolate key assets and sell those on your own and you have your own team and your own infrastructure to do that, that cuts more in favor of an asset purchase.
Interesting. So yeah, you talk about goodwill. So what's goodwill in a business? You said maybe the name, like what else would we consider goodwill?
Well, so it could be the name of the business is primary, which you could say, okay, fine. Well, we could isolate the name as a trademark and then we can license that or sell that to the new company. That's one element of it. There's also probably team, which doesn't traditionally fall into the category of goodwill, but I just want to highlight that because if you have employment contracts with key employees, key people who have built the company from the ground up, those are intangible human relationships that you can't just absorb through a trademark. If you have key salespeople who have great relationships, let's say you have a pharmaceutical company, you've got pharmaceutical salespeople are usually very key to bringing in money and really nurturing relationships out in the marketplace, very difficult to replace. You want to look at goodwill as, yes, goodwill is the name, and sometimes a company will have multiple brands as well. So you could maybe take a brand name, but does that mean you're getting the company behind the brand? Which is something
Mm.
that a lot of people look for as well. Goodwill is the currency, the social currency you've generated through your company. And when you buy into the company, you're more likely to be able to inherit and leverage that.
Interesting, interesting. Yeah, I mean, that's something we deal with a lot here is trademarks, and we talk about discussion about goodwill when acquiring a company. And because we do a lot with IP, that should be also a big part of people's transactions when they're thinking about acquiring a business. How are you acquiring an IP, whether it's through a holding entity where you buy stock or you acquire 100% stock, or is it through an asset transfer and assignment? These are all very critical elements you got to look at. And oftentimes the devil's in the details, a lot of this stuff, right? Even with diligence, I found over the years that people shy away from a stock sale because they hear, oh, all the liabilities that could come along with it. But as you mentioned, there's a lot of important advantages of that stock sale, especially given the industry. Like you said, if there's a lot of compliance, regulatory issues, maybe a liquor license, right? If you're talking about restaurants or bars, it really depends on the industry. So I would say that like every industry has its own approach. So if you think about buying a business, it's very different to talk about a SaaS acquisition versus a restaurant acquisition, right? There's just so many other elements you got to look at. So if you're a listener today thinking about, oh, I want to treat it all the same, it's not the same. We've done med spas, we've done healthcare, we've done hotels, we've done a variety of things, but they're all very different, and you got to understand the nuances of each. And some of them are very complex. And sometimes, especially smaller acquirers don't want to invest in diligence, but really that's where you uncover a lot of the stuff, right? So, Sahil, with your experience going through different deals, helping a lot of different clients with these acquisitions, walk us through the journey. What happens first from the start, maybe LOI or even before that, to the final closing? Walk us through what that looks like.
Yeah. Well, we usually do start with an LOI. That's the first thing we want to build. And we spoke about that on a previous episode. That those are the questions you want to hammer out early on to know that you're on the same page. Those are things like price. Those are things like a diligence period, escrow, as well as reps and warranties, key reps and warranties, indemnifications, who's involved in the transaction, broker's fees, key elements of the deal. Also, what survives the closing of the deal in terms of, for example, if you're doing a purchase that involves real estate, oftentimes the buyer is going to expect that the seller retains some kind of liability for environmental obligations. Those are key places you need to negotiate. And what kind of financing? Is this an all cash deal? Is this seller financed? Is this a deal that's contingent on financing? Does the bank need to pre approve this kind of deal in order for it to go forward? So, those are some key areas. The other thing is, what's actually being purchased. Let's say, for example, we're talking about a hotel franchise. That means we're talking about, is the flag going to carry over? Are there termination fees involved with that? What kind of service contracts does the current company have? Let's say it's a restaurant. Another thing that you're going to want to look at would be what kind of contracts they have, what kind of trademarks, IP they have. And so there are many key assets that you want to identify. And one of the key points that you want to highlight on an LOI will be the diligence period. And I think this is one of the most important parts of the deal because this is where you uncover where the bodies are buried.
Right.
And I
Right.
want to highlight a few of the bodies that can be buried.
Yes.
We always are looking at, especially we talked about hospitality and restaurants, labor compliance. You will often find that companies unknowingly or knowingly are violating California labor law, and a lot of those penalties run retroactively. You can't even correct them in terms of any kind of forgiveness going forward. Regardless, you could be exposing yourself to labor claims. We want to talk about liens and litigation. There are often times where a restaurant looks like it's doing phenomenally, but it could also be powered completely by debt. And
Yeah.
sometimes that debt can stack up over and over, and it really bleeds into the profit. And so you want to know what kind of margin you're getting when you're buying into a business. The other area, litigation. Are there any pending lawsuits that you would be inheriting if you were to purchase this company? The other thing is you want to look at the balance sheets and specifically the EBITDA. Oftentimes in small businesses, you're going to have owners who are putting their cars on their company card, their whole families on the health plan. You have a lot of expenses that are not necessarily true business expenses if someone else were to buy into the business. And so typically you're going to separate those out as costs so that a buyer would look at that and know actually what the true profit margin is here, because when you add back those expenses, you often will see that a business might be more profitable than it originally seemed. So EBITDA is something that's going to be very critical as well. And of course, the IP.
Absolutely.
But think about IP like real estate. Real estate, if real estate's a component as well. Any kind of ownership requires a clean chain of title. And so that's a critical piece. That means chain of title when we're looking at securities, when we're looking at real estate, and when we're looking at IP. And the
Okay.
other element I want to comment on here are cap tables. Most small businesses have a mess of cap tables because people have been handing out equity. They don't know if they've given someone a share or a profits interest or a unit or a percentage. People like to talk in percentages, but is that fully diluted or are these based on pre money valuations, post money valuations? Is this fully diluted or not diluted? People are just talking in numbers that they don't really understand in terms of what kind of ownership interests are being assigned. And so you want to look at everyone's ownership interests. What are the claims to ownership? How have the employee incentive options been outlined? Have they been awarded? Those are some key components there in terms of ownership. I would say securities, IP, labor.
Yeah. This is so good. Yeah, that's it's so important to think about all those. You raised great points about all the different elements you got to look at, analyze. Chain of title. Do people actually own what they're selling? What they're saying they're selling. Right. There's so much diligence, especially today with so much fraud out there. I think this even becomes so much more important. Right. So like, there's so many people who are, I feel like, so cavalier with just lying
Yeah,
today that I think
absolutely.
more than ever you need better diligence. You need to be very careful, question everything, right? And the importance of understanding that every deal is different, right? And people sometimes think, oh, I've got a template diligence checklist, or I've got this from ChatGPT. It told me what to look out for. But every deal is different, right? Like we're right now selling a hotel. We're working on a hotel transaction where the hotel may be closed down, maybe shut down. That's a very different analysis and diligence checklist than it is where they're selling it to another operator, right? So what does that mean, right? How do you handle that? And those are unique issues that you need someone to guide you through and think about and help you think about, because there's so many nuances here to every deal that you want to make sure you uncover. Because especially if you're putting in a lot of money, if you're putting in millions of dollars into buying a business, you want to make sure that you're getting what you bargained for, and it's something that can really help you make money. Because sometimes if there's more costs that arise that you didn't expect, that could really change the economics of the deal and may make it a bad deal.
So, Pankaj, I think when you're looking at diligence, if I had to flag two critical issues, I think we would be talking about contracts and IP. The equities, that's a given because if you're doing a stock sale, then absolutely you need to make sure chain of title is clear with the equities you're buying. But out beyond that, I think with the deal itself, I think when it comes to the assets you're purchasing, contracts and IP, making sure that those are properly documented and you're getting what you're paying for. I think those are the two most important. What do you think about like when you're looking at a deal, what are kind of the most important elements that you would flag?
Yeah, I think looking at the contract's IP, but like even then, higher level is like, is this person positioned to make the deal? Are they ready to make the deal? If we're selling a business, does the buyer have the money, right? Like, and if we're buying a business, does this person, what they're representing, is that actually what it is, right? Do you want to kick the tires, right? Think about buying a car. You want to test drive it. You want to look under the hood. You got to do all that with a business. So I think just verifying that person has, in fact, what they say they have before getting too deep into the deal, because the sooner you can identify the problems, the sooner you can make a decision and the more money you'll save, and be able to move on to the next deal that is the right deal for you. And I think that's one thing I like to tell clients, like we are counsel for deal makers and risk takers, but not every deal is a good deal.
Yeah.
And we want to make sure we help prevent people from getting into deals that are bad deals for them. And that's the thing, like when we're paid by the hour as opposed to a broker or something like that, we're not incentivized to get the deal closed. We're incentivized to get you the best advice possible for you to make the best deal. And I think that's also a big difference between hiring a lawyer and trusting a broker or another advisor who's compensated just on a fee for a closing. And sure, there may be success fees that lawyers get on some of these larger deals. But again, we are really incentivized by making sure, and it depends on what side we're on too, where a success fee makes sense. If it's in terms of like offering you just really practical, honest advice, we're the ones that have ethical obligations and also legal obligations and financial obligations just to make sure that you're getting the best advice possible for that deal.
I also noticed that a lot of people, when they're doing a deal, try to railroad each other with some
Mm.
very sweet but dangerous language. So
Hmm.
I notice a lot of times when we're working on a deal, people will say things like, "Oh, well, it's about trust," or "We're like family," or you hear all of this very kind of misleading language where people
Yeah.
like oftentimes I can feel sometimes our clients are feeling pressured to say
Yeah.
yes, or they start to feel bad about like asking a question is wrong. Like,
Yes.
I shouldn't even push on this or shouldn't even ask on this as somebody I've known for so long. That happens often where, let's say, this is maybe less in the context of someone buying a business and more when someone is investing in a business, but people saying, oh, well, I've known this person for so long. We're going to do this together. And I just want for all of our listeners to know that you have every right to ask every question.
Yeah.
And the other
Yeah.
person has the right to give you the answer they want to give you, and then you can evaluate what the answer is. But it's not wrong. It's not, I really hate this. I feel like there are some business people who will take advantage of other people's good nature and
Yes.
say, oh, well, you know what? This is about trust. And
Yeah.
you don't trust
Yeah.
me. We shouldn't do this deal. And I think for us, we would say if someone talks like that, you shouldn't do this deal
No,
because
I agree.
those
Yeah.
tactics usually mean somebody's lying and the numbers should speak for themselves and the business should make sense. I
Yeah.
feel like very often we're trying to keep people out of situations that don't make sense because they're getting pulled in by a reason that's not rational, a reason that's
Yeah.
not business. It's like
Yeah.
status or identity or some kind of emotion that doesn't have to do with the rational basis of the deal. And
Yeah.
what we're here to do is pour cold water on everything
Yes.
and just say,
Yes.
does
Yes.
this make sense? And you have every right to ask if it makes sense.
Yes, absolutely. So you bring up such a good point, Sal, because I think it's easy to overlook. And honestly, it's human nature. It's almost impossible to, especially smart people, think, oh, they know what's best. But honestly, when you're too close to a deal, when you're too close to the other side, where you're friendly with them and you guys have a good rapport, you kind of let your guard down.
Yeah.
And you need a third party to come in and ask hard questions
Yes.
because maybe you're not comfortable now because you guys have a good rapport. I'll be the first to admit that that happens to me sometimes, right? I have
Oh,
example like I'm having someone build cabinets in my or closets in my house. He gave me this contract. He's like, "Oh yeah, I'll bring over the contract." He gave me this thing that was like handwritten garbage. And I'm like, if I was advising myself as a lawyer, like this is nothing, like this is useless. He just
yeah.
wrote down like the 5 things he's gonna do, but I'm like, okay, what is it gonna look like?
Yeah.
And I realized like I wouldn't because I've been talking to this guy for a while. Oh, I'm like, okay, how much trust do I want to put in this
Yeah.
guy versus how much I want to document? Went back a little bit, but I didn't want to overdo it because
Yeah.
at the end of the day, there was a balance there, and you also have to look at
Risk
the amount of risk you're taking
tolerance.
too. But yeah, those are things that come up all the time, right? So like, I'm talking about closets, which is a few $1,000s versus multi-million-dollar business where you want to take a little bit more precaution, right? Like it's not going to break me if he doesn't do the best job and I have to deal with it. But I also looking at his reputation, his skill. He's done closets for my in-laws. So like I know he's actually trustworthy, but there's still a balance there, right? So I think you have to be really careful when you're too close to the deal too. And it kind of lulls you into complacency when there's bigger deals. You got to go through the process and follow the steps of diligence to make sure you don't overlook anything.
I'm thinking about a deal, Bunkage, that we both worked on where the buyer asked for an extension on the diligence period. And we advised our client just to ask for a nominal fee in exchange for extending the diligence period, which would have been a huge concession from our
Yeah.
part because there was actually, what we should have asked for would have been a much larger number in order to extend the diligence. And even then, we were thinking, okay, well, we've had no activity so far in terms of questions regarding the diligence, and we have no assurance that this person is actually going to buy. And so, in the end, the client felt comfortable enough with the buyer, and the buyer said, well, hey, don't you trust me? I definitely want to do this deal. This means so much to me. I really want to do this deal. I've just been traveling and I've been busy, which I hate the traveling excuse. You have
Yeah.
Wi-Fi on the plane today. You
Yeah,
have you
exactly.
have access.
Exactly.
Yeah, you have access to your device. Oh, I'll get to it once I'm back from traveling. This is not the 1980s. It's not an
Yeah,
excuse anymore.
seriously.
Just get
Seriously.
on your phone or get on your laptop wherever you are in the world. It doesn't matter. It's a silly excuse today. But anyway, this person was making all kinds of excuses, kept saying, well, don't you trust me? Don't you trust me? Now we do extend the diligence period. And then at the end of that period, the person backs out, not because they felt like they were being disrespected because they were asked for an additional fee for an extension on diligence, but because they got denied by the bank for the money. So in that case, this is why we advise clients to, hey, stick to your guns on things like this. Talk is cheap. People will say anything that's in their self-interest and they're really
Yeah.
not looking out for you.
Yeah.
So,
Yeah.
when it comes to a deal, you want it when you build out the deal terms, the words on the contract, the words on the page are meant to protect you because
Yes.
we're human beings. We have emotions. You know what it reminds me of? You know, in the Odyssey, when Odysseus is passing through the sirens on
Yes.
the boat. Oh,
Yes.
you know, he's been told that they're so that the sound of their voice is so tempting that the boat will crash against the rocks.
Yeah. Yeah. Yeah.
That's what Pankaj and I are here for. We
Yeah.
tie your hands to the mat, make sure you don't sail into the rocks, because we're all human beings. We all have that
Exactly.
weakness of, we want to be caring, we want to be kind, but there are certain times where you need to stick to the words on the page because they're there for a reason. They are
Absolutely.
your protection.
We're gonna tie you to the mast if
Matt,
necessary.
yeah. And that way we
To
can
protect
sail
you.
through it, get back to it.
Yes, to protect you. Exactly. So I think that's a great place to end. I think this has really been really helpful. Great kind of crash course on the things to think about when buying a business. So if you're listening, we really appreciate you guys listening, your continued support. I think we're probably at over 50 episodes now, and we're going to continue to do this. We'd love to hear back from you. We'd love to hear insights and comments and any war stories that anyone wants to share. If you have thoughts, if you'd like to be a guest on the podcast, please let us know. We always love to hear from people doing these kind of deals who have been in the trenches, and we'd love to hear other perspectives. So until next time, we really appreciate you all in listening to us and continue to support us. And we will be on next week with another episode of Letters of Intent. Wednesdays at 7 a.m. It drops. And until then, happy deal making.